All right, it is 1 o'clock. Hi, everyone. Good afternoon, good evening, and welcome to Saxo's webinar, Using FX to Potentially Boost Income. My name is Ida Johannesson. I'm head of commercial ESG at Saxo, and I will be the moderator. I'm here with Sharu Shanana. Let me just share my screen. I'm here with Sharu Shanana, who is Saxo's head of FX strategy. Sharu has been with Saxo since 2022. She has a lot of experience in financial markets with a background in equity research. She's also a regular contributor to top-tier media outlets such as Bloomberg, Reuters, CNBC, and BBC. I've known Sharu for a few years now, and she's quite knowledgeable. I believe we are in good hands. Here is the agenda for today's webinar. Sharu would walk us through what is FX, the benefits and risks of trading FX. She would explain some FX strategies, as well as walk us through the platform and show us how to trade FX. At the end, we have about 15 minutes for your questions and a short survey. You can ask your questions anytime during the hour, or you could do it during the Q&A session. Now, before we get started, some important information. FX are complex products and are not suitable for everyone. Today's webinar is for informational and educational purposes only, and it is not a recommendation to buy or sell any FX products. Investing involves risk, including the risk of loss. And as a general rule, you should only invest in products that you understand, or at least you understand the risk associated with those products. Past performance is no guarantee of future results. And before investing, you should consider your own situation, investment objectives, time horizon, and risk appetite. And here, Shao, you have the floor.
Thank you, Ida. Okay, and good morning, good afternoon, good evening to everyone for joining us on this webinar today. Certainly discussing this fascinating world of foreign exchange, right, or FX in short, which is obviously something each of us is familiar with in some scope or the other, right? I mean, whether you travel abroad or you have, international investments, you have exposure to FX in some ways or the other. But for the purpose of this webinar, we're going to keep it to some very, very basic, understanding of what FX is, how it works, what are some techniques that you can use to trade FX, and of course, like Ida said, in the end, we'll also run through the Saxo platform once. But certainly, I think feel free to drop in your questions at any time, and we'll get to them either in between if they are relevant to what we're talking about already, or we get to them right at the end of the session as well. So let's start with really just the very, very basics around, what is FX. FX is a little bit different from stocks in a way that you don't tangibly hold anything when you buy an FX pair or sell an FX pair, right? So it's really about speculating on the relative value of one currency against the other. In every FX trade, you are simultaneously long one currency and then you're short the other currency. So basically, you are just trying to kind of bet on that the one currency will strengthen against the other, which will weaken. So this is just the simplest way I can put it, right? I mean, I think it's also, you can look at it in terms of what is the timeline that you're putting that trade on for, whether it's an intraday trade within a day or more time. if it's with a time horizon in mind, you can just think of it as trading a future as well. I mean, I'm just talking about spot here. Particularly, we're not covering FX futures and options and other strategies. Of course, there are other things as well that we can dig into as we get more advanced. But for the purposes of today's discussion, whenever we refer to FX, we'll be referring to spot FX positions. Then I mean, FX markets are certainly, global in importance. Like I just said, it's vital to consider for any international investor, because exchange rates affect the trades, they affect your investment returns, they affect overall for countries, it affects their economic stability as well. So a range of implications there are from FX movements, right? And I mean, if you talk in terms of which are the most important currency pairs, the G10 space, that is certainly the space that is the most liquid. You would see US dollar, euro, Japanese yen, British pound, Swiss franc, Australian dollar, the Canadian dollar, the Kiwi dollar, the Swedish krona, and the Norwegian krona as well. These are the most liquid currencies, really. There are some other developed market currencies as well. Uh, these are also quite significant in the overall FX space, but a little bit obviously less liquid than the G10 peers. Then there are these emerging market currencies, as you can see again, the Mexican peso, the Turkish lira, South African rand, Chinese yuan, and so on. So these are also interesting to some traders, I would say, particularly for their higher volatility and the potential returns that can generate in some key FX strategies. Then there are, some of these other ones. These are called the NDFs, or non-deliverable forwards, like the Indian rupee, the Indonesian rupiah, or the Brazilian real. They are traded in a specialized market because of restrictions in their home countries, which actually prevents the actual delivery of the currency itself. So I mean, this is just the basic, around what is the FX market. And as I said, right, you usually trade FX in pairs, and more often than not, US dollar is the reference currency. It is actually the global reserve currency. It is most widely held reserve currency globally. It is held by central banks. It is held by institutions for foreign exchange reserves, for trading purposes. So it is actually the most dominant currency in the FX space. Whether you consider trade transactions, financial contracts. So there's this data set from the Bank of International Settlements, which is actually the central bank of central banks. So they come out with the a report on the FX markets every 2 years, I think. And the last one in 2022, they said that the US dollar is actually used in 88.5% of all FX transactions. And then that's followed by euro, which is again in 30%, and yen 17%. Of course, you can trade crosses as well. But as you keep going down the list, the liquidity, I would say, gets lower and lower, and that's because, of course, the number of transactions involving that particular currency is lesser and lesser. So I think, I mean, in a sense, what I would want to say here is that when you're trading FX, it becomes really important to understand where the US dollar is going, what the US economy is doing, like with most of our other investments as well, but particularly in the FX space. So what makes the FX market attractive, really? I mean, the first thing, like I said, it's the liquidity is staggering. The BIS data again that I referenced earlier, it mentions that the daily volume back in April 2022 in the FX markets was $7.5 trillion. So I think that's just a massive amount of liquidity, which is important because that ensures that traders can enter, they can exit positions with minimal price slippage, really, even if your trade size is generally larger. It just means that your trades will be quick, they will be efficient, just because the liquidity is pretty good. Then the FX market trades 24 hours, which is a positive but also a negative, especially if you're based in Asia and a lot of action happens overnight and you kind of have to stay awake to see, especially when you have exposures. I can really not sleep very well. But yeah, I mean, it's a 24-hour market, which is obviously quite attractive to a lot of traders as well. You can trade it across time zones. So theoretically, also there's no gap risk, because it's trading all the time. But of course, there are periods of thin liquidity in between, sometimes when the US closes and just before Asia really comes online. So very, very early morning hours for me, I would say, there would be a little bit of a price slippage when you have traders only maybe in New Zealand or maybe other parts of Australia joining in. I think that's really some scope for slippage, but it's not like equities when you see like an earnings announcement after the market close and then you have an after hours moves, which is quite massive nowadays. It's pretty normal to have a 10% move up or down in the aftermarket. So I think, yeah, of course, FX is something which does not see those kind of price slippages. So that's what makes it interesting as well. Uh, there's obviously leverage is a huge factor why many people trade FX. It is a good thing in cases where say a company wants to hedge $50 million, then you don't need to have a huge amount of capital to be able to do that. You can really do it, on a thin slice of capital with, say, if the leverage that you are being offered is 50:1, then the trader can really control $50,000 in that currency with just $1,000 of margin. So that makes it obviously easy to have large exposures without really putting all that capital aside. But obviously, I mean, leverage, as we all know, comes with its own risks as well. I mean, it magnifies your gains, but it also magnifies your losses. And when things go down, again, because of leverage, you get hurt a lot more in your exposures. So I think that's something to really keep a note of. But otherwise, of course, I mean, it's really an intriguing market. Is not something that you can have an isolated view on. You need to have a view of the entire world. There's lots of moving parts. There's monetary policy, interest rates, economic growth trajectories, commodities. So different currencies are exposed to different factors in some way or the other. If you talk about commodities, currencies like Australian dollar, because Australia having a more commodity exposure in general as an economy makes Australian dollar react a lot more to certain commodities, say, such as the iron ore. Or, if you're talking about risk aversion, then something like a Japanese yen or a Swiss franc, those are certainly more, more immune to those moves or sentiment around risk. So there's a lot of moving parts, and you kind of need to have a very, very broad, holistic view of the fundamentals as well, even if you're just trading FX, like based on technical factors. So it is certainly a trader's market, where you can try to capture intraday moves, and again, leverage tries to help you to magnify your gains even with small intraday moves. But it is very much a macro market as well. So I think that's what is quite interesting here. And yeah, it has a wide scope, certainly. Lots of users between in central banks, banks as well, corporations, hedge funds, traders, speculators, as I said, asset managers. So that's, again, the more number of people using this market, that's what is contributing to the amount of liquidity that we have here as well. So quite interesting, I would say. And then let's just get familiar with a few basic terminologies around FX markets. I've listed a few here, but of course, if there's more, again, feel free to drop them in the questions. So, the quote convention, there is obviously a standard way how FX pairs are quoted. Uh, like I said, there are two currencies that you're trading. One is being bought, one is being sold. So the first currency in the quotation, like in this case, I've written euro dollar. So in this case, it's the euro. And this is called the base currency. And the second currency in that quotation, which in this case is the US dollar, that is known as a counter currency or a quote currency also. And like I said, there's a standard you follow. What comes in the numerator and what comes in the denominator depends on the rank, and the ranks are like, so euro comes right at the top. So usually whenever you are trading a currency against euro, euro will usually always come, I think, at the top. That's what I've seen. Euro dollar, euro sterling, euro NOK, euro Aussie dollars. So euro will be at the top because in the standard ranking, euro is at the top, and then it's followed by sterling, then Aussie dollar, and so on. So that's the standard convention. Currencies with a high rank go in the numerator. Then what are these bid and ask prices? I've put them here as well. This is a slightly older snapshot, but you can see the bid and ask prices are obviously not where euro dollar is trading nowadays. It's above 111, but I mean, just to give you a sense of what they are. So you sell the bid price or you buy the offer price. So the bid price is actually the price at which the market or the broker um, he's willing to buy a currency pair. So you sell to the market or to the broker at that particular point. So it's the best available price at which you can really sell. Then the ask price, obviously, that's the opposite. It is the price at which the broker is willing to sell a currency pair. So it's the best available price at which you can buy that particular currency pair. Then the next and a very important aspect to pay attention to is the spread, something that you can see here in between the bid and the ask here. That's the difference between the bid and the ask prices of the currency pair. Uh, that is what really represents the transaction cost for the trader. So in this case is 0.6 pips. So and this will vary. This will vary depending on what kind of account you have. Usually smaller accounts that don't trade a lot, they could have higher spreads. Somebody who's depends on which currency you're trading, depend on the type of account you have. But this is something really important to pay attention to. Then what is pips? Pips is really the smallest price move in an exchange rate. It is typically we quote FX rates to the fourth decimal place, except for dollar yen, I would say. But really, the smallest move that you can see is the pips. A lot size is the amount of currency units that are traded. Standard lot size usually $100,000. Here, like we're trading $110,000, for example. There are mini lots as well, or even micro lots that some could offer potentially. But it's really just determines what are the number of units of that currency that you're trading. And margin, that's again quite important because again that is a reflection of what is the amount of leverage you're using in your position. So when you say the margin amount, and I'll show all these things when we go to the platform as well, where you can see all of this. But really, margin is the amount of money that is required to open a position or to even maintain a position because these are leveraged trading positions. So it's essentially what is the security deposit that you need to have in place to be able to open the position of a size that you're willing to open. Like we discussed, a 50:1 leverage earlier. In that case, your margin to open a position would be 2%. Okay, let's go on to the risks. Obviously, it's no easy job trading FX. I don't want to make it look very simple. There are certainly a lot of risks around it as well. Risks such as, of course, exchange rate risk, where there's going to be potentially some currency price fluctuation, some factor that you did not kind of evaluate while taking that position, or some factor that moved in the direction against what you were expecting. So there will be fluctuations. There could be fluctuations in currency prices that can negatively impact your position. Say, you're long euro dollar, but euro depreciates sharply against the US dollar. Obviously, you make a loss. So that's certainly a risk we need to be aware of. There's interest rate risk. I mean, I think, of course, the exchange rate risk is a little bit more straightforward, but the interest rate risk also matters a lot for FX traders, because changes in interest rates by central banks will affect currency values as well. So, if, for example, if the Federal Reserve now expected to cut rates, then the US dollar could depreciate quite a bit. We've seen the US dollar depreciating just in anticipation now of the Fed to start cutting rates, with the dollars trading at 1 year lows, at least the lowest since December. So I mean, we need to be aware of where the interest rates for the different economies are going to be able to trade again, and that does not translate into your currency values directly. There are, like I said, there's just a lot of other factors playing a part as well. Then, of course, leverage is uh, the thing that makes FX attractive, but it's also the thing that makes FX trading a lot more riskier as well, because I mean, it just magnifies your losses as well if your trade moves in the direction against what you had expected it to. Fundamental risks, policy risk, like I said, political events, geopolitics, government actions, any of those sort of risks that can again lead to unexpected and extreme currency movements. There are a lot of factors. They're very intertwined as well, and not just what happens, but also what is the positioning in the market currently, what is being expected generally, and whether it is in line with what was expected or not. Sometimes the data that comes out is very good, and you would expect that would have positive impact. But if that data was very well expected to be good, the impact could be neutral on your FX trade. It could actually be even negative if the data was not as good as expected. So yeah, there's a lot of fundamental factors really playing a part here. Then certainly behavioral, I think risks are also pretty high on the list. When you're trading anything, but particularly when you're trading FX, it's there's like things like fear, greed, frustration. They can all lead to irrational decisions, chasing losses, some revenge trading maybe. So I think over trading certainly is one of the key risks as well, which we should certainly be aware of and try to avoid when we're trading FX, or actually anything for that matter. Moving along, then I think it's a good time.
Shadi, just one question
Yeah.
before you go into the next section. You talked about the most important pairs earlier, and we have a question from Ben who's asking, which FX pairs would you recommend trading primarily?
As our disclaimer earlier said, right, we don't recommend, but I would say certainly something that you have the most conviction on, the most knowledge on. I mean, technically speaking, like I said, the liquidity is the highest in pairs like euro dollar, dollar yen. A little bit lower than that would be sterling dollar, Aussie dollar, and the likes, and G10 certainly higher than the emerging markets. But I mean, really, it depends on your expectation, your risk profile, and what are you trying to achieve. Where do you have the most expectation of a move as well? I think those are some of the things that will determine which pair you take a position on. And if you're doing, I would say, I mean, I'm going to come to the strategies later on, right? But if you're doing some amount of say speculative trading, like where things are going, then of course you need to know what data is coming out today. Say, for example, today is the FOMC minutes coming out from the Federal Reserve's last meeting, and you expect them to tilt dovish. Then, I mean, when I'm trading dollar, I can obviously trade it against a variety of currencies. But if I'm looking at a move in treasury yields to be quite pronounced, then it is the Japanese yen that has the most direct impact from moves in treasury yields. Again, that's what I said. You need to know the factors, you need to know the fundamentals that will be important, but also how different currencies react to those factors as well. So like I said, the yen reacts the most to a move in treasury yields, and then maybe I would take a position in dollar yen. But if I'm looking at say a data point, say a eurozone inflation coming out today and expected to be softer than expected, which would probably make the ECB cut rates faster than, say, the Fed, then I would take a position of being short the euro dollar. So it really depends where you have the largest conviction, honestly. So are we good to move ahead now? Or are there any more
Yes,
questions you
yes,
have?
that's okay. We can move ahead.
Right. Okay. So yeah, let's start with that next section on FX strategies to potentially boost income. And I mean, again, I don't want to give the impression that FX is easy. Can you make a living out of just trading FX? Yeah, maybe it's possible if you have the time, if you have some excellent research skills, if you have a good risk appetite as well, and you get the timing right of when to enter and when to exit the position. But when we talk of FX, it's certainly something that's more of a trader profile than investor, or at least I would say it's more of an active investor profile. So I mean, of course, I'm going to discuss four strategies today here, but it's certainly, again, like I just said, it's really depends on what kind of risk profile you have, what kind of an understanding, or what kind of a conviction you have for those currencies to move in which direction. So the first one is opportunistic trading. It's basically speculative trading, right? A very short term view. Euro dollar is 111. I think it's excessive. I think it could go down from here. It's as simple as that. So you take advantage of short-term movements in currency pairs, something that's driven by, again, your understanding of macroeconomic trends, your understanding of where the economy is headed, where the interest rates are headed, what geopolitical events could do, something like elections, COVID, what wars can do, what market sentiment is like currently. When you get an understanding of this and what currency pairs it will move, then you take a position in that currency pair. And a lot of times, what we also have seen is a popular strategy in opportunistic trading is something as simple as that a currency pair has moved higher for the last 3 days, 5 days, 10 days, whatever, and you try to kind of fade the move as well. So that's extremely speculative. But if you're obviously trying to link it back to fundamentals, then I mean that's obviously called opportunistic trading. Now, the example that I've shown here, it's for sterling dollar at the time of Brexit, when the Brexit referendum happened in 2016. What we're doing here is really, I mean, if you, so this was June 23rd, 2016, right? And there was obviously a sharp depreciation of the British pound following that unexpected vote in the UK to leave the European Union. Now, as an opportunistic trader, if you saw the referendum results, potentially you would want to short the British pound against the US dollar in response to that outcome, because that was something that was not expected by the market. So there was obviously a good chance that it would kind of result in some moves in the FX space. And so traders who kind of anticipated that kind of a reaction to Brexit, they acted quickly. They were able to capitalize on this sharp depreciation of the pound, and it happened. Obviously, the sharpest depreciation happened on that day, but then again, we did see the pound continuing to move down again in September, and I think there have been after effects of those kind of announcements that the market did not completely expect. Now, again, I would go back to saying that there are factors like fundamentals, like geopolitics and things, but there are also correlations that we need to really understand here. Like I said earlier, the Aussie dollar, it's a commodity currency. Price of iron ore is going up. a sudden drop maybe uh, uh, happens in the iron ore prices, that might lead to some weakening of the Australian dollar, and that could potentially create some trading opportunity there. Same way, the Canadian dollar, it is usually seen to be linked closely to oil prices. So if you see a shift in the trajectory of oil prices, now that can directly impact the Canadian dollar. But again, there are going to be a lot of other factors at play as well, which might be impacting the Canadian dollar. So you kind of need to have a little bit more holistic view. But if you're just trading for the very short term and sudden unexpected movements happen in fundamentals, those can sometimes be used as just catalysts for taking an opportunistic position in the FX space. Then the second strategy, and I think this has been very popular last few years, I'm sure a lot of you have heard of it, probably even implemented it, is the carry trading strategy. So what happens in carry trading is that an investor borrows money in a currency where the interest rate is low, and then they invest it in a currency where the interest rate is high. So then what happens is, I mean, of course, you're selecting two currencies here. The borrowing currency, it's called the funding currency, typically the one with the lower interest rate, and you are investing it in a currency with a higher interest rate. That one is called the target currency. And the idea is really to profit from the interest rate differential between these two currencies, not so much from the movement in exchange rates itself, but really the differential in the interest rates of those two countries. Now, as time passes, you earn the interest on the invested funds in the target currency. So this is the carry that you're earning, and I think it is really important. Yeah, certainly it's important to have that interest rate differential so that the interest that you're paying is far less than the interest that you're earning. So you kind of get to keep that carry. That is the positive carry that you have. That's certainly very, very important. What is also very important for carry trading is to have low volatility. Now, why is volatility important? Because you want to minimize the risk that the currency pair will move in an adverse direction and wipe off all of the um, carry that you're earning. So if the volatility is low, if the pair is moving sideways for a long time, and those two currencies have a good interest rate differential, that is the ideal time that carry trades are put on. I mean, if of course the exchange rate can move in your favor, that's excellent. That adds on to your interest rate differential, the carry that you're earning. But at worst, the exchange rate should go sideways. It should not go adverse, because, like I said, it can just erase all of the carry that you generated out of those interest rate differentials. So the example that I'm showing here is for Aussie yen. It's a very popular carry pair as well. And this time period is between 2003 to 2007, where things were pretty stable in terms of the global economy. During the mid 2000s, we had Australia had really high interest rates compared to Japan, which was obviously lower, negative, even zero interest rates. So the Australian dollar, that's why it was very popular target for carry trades. It gave quite steady returns, as you can see with this arrow from 2002 to 2006, 2007 something. But as I highlight below in big bold letters, this is a very famous saying that carry trades go up the escalator, but they go down the elevator. And that's exactly what is very evident in the chart as well. Because the carry trades can generate steady returns over time as you accumulate the interest rate differential. And when market conditions are steady, but during periods of financial stress, and that's exactly what happened in 2008, these trades can unwind very, very rapidly. And if you are an active trader, you would probably have some very, very recent experience of this in the market as well, where dollar yen 2 weeks back also kind of came down very, very quickly just because of some concerns around a potentially a US recession or the Fed cutting rates much faster, whereas the Bank of Japan is raising rate. So that interest rate differential gap is closing, and the volatility was much higher in the markets as well. And the collapse in the dollar yen was quite significant. Yeah, I mean, I think that's something we really need to be aware of. In case of any severe risk aversion, some financial stress, these trades can unwind very, very rapidly. So, probably always a good idea to have some tight risk management around these carry trading strategies, because these are more long term in nature. They can give you good returns, but only as long as volatility is low. So, that's very important to keep in mind.
I actually have a question, Sharu. Funny enough, I heard about carry trades in connection with Japanese housewives. My question to you is actually what happened to those housewives? I believe we call them Mrs. Watanabe. Were they successful or did they crash and burn just as you show on your slide?
No, I mean, you're absolutely right, Ida. It's the Japanese yen, because of its zero interest rates for such a long time, has been one of the most popular funding currencies for carry trades. And of course, this is the reason Japanese wives have been really using their pocket monies, and investing it in US dollar based assets. Now, what happens to them is, of course, I mean, I would assume that if they are doing this in large amounts and as the primary source of income, they also probably have hedging strategies in place, something like, of course, using stop loss orders to limit potential losses if the trade goes against you. Have a hedging or an offsetting position as well. And by that, what I mean is, of course, they have significant amount of assets in the Japanese market itself as well, which at least gain, because of at least when the carry trade is not moving in your favor. So there has to be an offsetting position to that as well. So basically, I mean, it's really about, like in any other trades or like in any other investments, it's about diversifying your portfolio, avoiding excessive leverage. In fact, that could be also very important. I think, yeah, it is, because this is one of the most important long-term strategies in FX. The others are mostly, like I said, it's a space where, which is for more for trading for shorter time horizons. This is a strategy where you can just sit and forget about it, and hope for things to not go against you, because if they do, they can just go there pretty rapidly as well. Can't hear you, Ida. I think you're muted.
Okay, thank you.
Okay, great. Let's jump on the next one quickly then. Is about diversification with FX. We can also call it diversification within FX. I think that's also important. So, I mean, but of course, as we all know, right, diversification is the only free lunch in investing. It is really the process of spreading your investments, across different asset classes, across sectors, across countries, across industries, and when we're talking about FX, across different currencies as well. Now, how do you add FX or add diversification to your portfolio using FX? Certainly, I mean, it's again highlighting the fact that it is a market that has high volatility and high complexity. So it is a market that has never been explored enough, I would say, because of those challenges on how it can help to diversify your portfolios. But I think there are some very interesting ways you can do it. Just to start with the fact that most investors are in general always overexposed to their home currency. So I'm based in Singapore. Whether I see it like that or not, but most of my investments are in Singapore dollar. Even though, again, my equity portfolio is probably a little bit more tilted towards the US dollar. But if you account for your, say, housing, and all of your other assets as well, you would obviously have potentially a larger exposure to your country of residence. Now, in that case, it becomes tricky specifically if you have some expenses, either present or future expenses, to other currencies. Some planned expenditures. You maybe want to buy a property. You are maybe repaying a foreign loan. Maybe your kids want to go abroad and study at some in some time in the future. You will need to have expenses in a different currency. I mean, as simple as if you're traveling abroad, right? You will be incurring expenses in a different currency. So just to avoid an asset liability mismatch, investors need to consider currency diversification, have some exposure to different currencies. So basically, just holding your cash or your investments in some different currencies could help mitigate currency risk. It can also help to stabilize portfolio returns. Um, the example that I'm showing here is one of somebody investing in the US, and what happens when US stock markets go down. So remember, when you look at this one here, and this is obviously a chart which is normalized at the starting point here. So, but when you see the US stock markets going down, as a and this is 2008, so remember, again, we're talking about the GFC, the financial crisis. The collapse in equities did push safe haven demand higher, so it pushes up the US dollar as well. And if you have exposure to the yen and you have sold dollar yen, that is again so closely correlated to the S&P 500 that if the yen appreciates in that crisis, it kind of offsets the losses that you make in your US dollar portfolio. So basically, I mean, it's just about again, it's about spreading your investments, but it's buying something that is either negatively correlated, completely negatively correlated to your current exposure, or, or less correlated. If I just buy another, say, a tech stock, and I have an S&P 500 index exposure, it all moves down in tandem. But on the other hand, if I have some yen exposure, at least it moves in the other direction and kind of offsets the losses that I incur in my equity portfolio. So I think that's really important to consider as well. A key strategy, I think, if you already have some planned expenses, of course, have some cash in those currencies, have some investments in those currencies. But as a general rule, to kind of just to make sure your portfolio is diversified enough, have some exposure to some of the different currencies or investments in different currencies as well. And the last strategy that I wanted to discuss today, hedging. Again, this is something which is a lot more popular with, those who are involved in trading goods and services. This is actually where the FX markets really started. It basically about protecting against potential losses in either your business operations, like I said, those who do are involved in global trade. They certainly look at hedging with FX a lot more than us, probably. But also, I mean, if you have, like I said, if you have a portfolio with international investments, then again, hedging that portfolio could be very important, because sometimes unfavorable currency movements can erode the gains that you've been making in your equity or otherwise in your overall portfolio as well. So the goal of hedging, I mean, it might sound a little bit similar to diversification, but the goal of hedging is not to generate profit. But why are we discussing it in a place where we're talking about strategies to boost returns? Is to so that we can really boost returns by reducing the risk, or by locking in exchange rates, favorable exchange rates, or by offsetting potential losses in our portfolio. So I think that's what hedging is all about. And I think the very interesting case in hedging here has been the exposure to Japanese equities, which have been quite popular for the last year or two, since Berkshire Hathaway disclosed some investments in Japan. Now imagine if you have significant investments in the Japanese stock market, but you're concerned that the Japanese yen might depreciate against your home currency, say the US dollar. Then a falling yen will diminish your returns. Even if Japan's stocks continue to go higher, a falling yen will erode the kind of gains you make in your base currency, in this case, the US dollar, say. Now, to hedge against that risk, you can either buy a forward contract or options, or to lock in the current exchange rate, or for future conversions. I've written other articles as well, so maybe I will show you where to find them when we jump onto the platform. But I think just being aware of which currencies you have exposure to, and then hedging against unfavorable moves in that particular currency against your base currency is also, I think, a powerful tool to kind of protect your investments and hedge against potential losses. And I guess that brings me to the end of the slides, but let's just jump onto the platform, and I'll be very quick. I know we're running short of time here. Okay, I hope you can see my platform now.
Yes, we can.
Okay, cool. So I'm at this trading tab on the platform. And if we go to watch lists, I mean, you can create your own watch list. For example, I've created this watch list called Key FX Pairs. You can obviously create a new one from here, give it a name, and keep adding your pairs in it. Or if not, you can obviously just search any FX pair here and go to the spot of FX, and you can just go to the chart for that particular currency pair as well. But here it's, I think, I've just to be convenient, I've linked up all of these currency pairs to the different chart formats that I have here. So our platform really provides a lot of technical indicators that you can use if you have that knowledge of technical analysis. I maybe will show you, like, this is a daily chart, and I've added some moving averages here. You can just go here, add some moving averages, and RSI, Bollinger Trends, MACD, any kind of technical indicator that you're familiar with and that you use in your day-to-day trading. You can obviously add that here and help that to understand where things are going. And when you enter a trade, you would see that here. So I just entered this like a few hours ago. It was a long dollar yen position, and it is showing you how it is trading right now. This is still an open position, and you can close it when you like. But how do you really go about putting in an order, right? So this is your trade ticket here, as you can see now. There are obviously different types of orders. The market order, where the order is executed at the current market price. So basically, this is for immediate execution. Limit order, where you want a specific price that is better than the market, then you kind of enter in what price you want here. There are the stop orders, stop limit orders, and like, I mean, I usually just go, maybe I'll show you the simplest one, being the market order. So when I want to buy or sell, you want to go long or short on the pair. That is obviously something to be extremely careful about, especially in your first few trades. If you think that the yen will appreciate, that means the dollar yen will go down. So I would want to be short the dollar yen in that situation. So I think anything like that, and then you probably, obviously, you can change the lot size as well. We discussed what the lot size is, and you could just go ahead. You could change that as well, say, and you could place an order. You say confirm, and there you get your trade confirmation that the order has been placed. Now, talking about say trading costs, of course, that's the other important thing that we need to be aware of when we are trading FX. So when you go to the trade ticket, this I at the top will take you to the details of the trading costs. And I guess this is and this is a demo account, so it's showing commissions. I don't think Saxo charges commissions on FX trades. Maybe I have some snapshots on my slides, and it's probably better to share that in this case. So I'll take you back to the slides. Okay, there. So this is the slide on trading costs. As you can see, I mean, I've already showed you in the platform where to go, but this one is actually completely telling you what the cost is. The spread certainly here. This is the key cost, like we discussed earlier. It's the difference between the bid and the ask price for the currency pair. The swap points, as you can see here on the slide, this is the interest rate the interest rate differential that you're paying or you're getting, right? This is really what you pay or you get on an everyday basis. So it is a per day swap price. A positive value usually means that you earn the interest, and a negative value indicates that it's a cost for you. And then finally is the financing cost, because again, remember, this is a leveraged position. So that this financing cost shows what is the amount of interest you're paying on taking leverage in that position. And then if you go to the instrument as well, you'll be able to see what margins you can have in place for this particular position as well. And I actually wanted to show the effect of carry as well, which is pretty evident from these right hand side snapshots that I have. These are dollar yen costs. So the first one is for the dollar yen long position, and the bottom one is for the dollar yen short position. So when you're long, your cost, your swap points, because you know there is a massive interest rate differential, your cost is negative. So in a long position, you are earning the carry. Cost being negative means it is positive for you. When you're taking a short position instead, the cost is pretty it is overbearing, right? To put on this position and kind of just forget about it, and especially if the exchange rate does not move in your favor, you are paying a cost of 6,700 yen, per day. That is being deducted from your account as well, in this case, in the short position. And maybe I'll just quickly go back to the platform.
While you do that, I'm just gonna say that we've gotten a lot of questions. Some of those are very client and account specific. So I suggest that you contact our client service team. They will be able to help you with those. When you're done with the presentation, then I'll start with the questions. Shall we?
Right. I mean, I think just the last thing, Ida, from my side is, like I said, right, risk management is very, very important when you're doing carry trading. So I just kind of wanted to show that here. So, for example, we have this dollar yen position, and you can just right click on it, and you can, again, it doesn't show here. Maybe I'll just take a new position and see if it shows. So yeah, you can add your take profit and stop loss levels. I think that is something extremely critical when doing FX. I mean, in fact, risk management is important in any kind of trading as well, but particularly important with FX because I said, like, it's 24 into 5. It's a market that is open, and you could be potentially you're not watching it and the thing moves in against the direction you had hoped for. So it's always a good strategy to have some risk management in place. And it's as easy as that. You can also do it in your existing position. I'm not sure why it's not showing here. Oh, yeah, you could add price alerts too. I think that's also interesting. And lastly, I'd just like to highlight the inspiration page. When you go to research, you go to inspiration. You have a lot of FX insights here from myself and from my team as well. The technical updates from our technical analyst, and I have more of those fundamental updates. For example, I wrote something on the US dollar. These can certainly be used for some inspiration in, there was a question previously as to what currency pair we should be trading. Of course, find your inspiration on this page. You can also find technical inspiration on this page called Trade Signals. I find this very interesting. It tells you about which currency pair might be is emerging, approaching, or breaking out of its range, breaking out of its key resistance or support levels. What is the probability of that move as well? Higher probability, for example, it's showing Euro Swiss is approaching a resistance level of 97.88. So things like that could be, from a technical perspective, quite interesting as well. But yeah, I'll stop there and let's take a few questions now.
All right. Just for your information, the recording will be available tomorrow, so you can find it on our website and platform. Now, there's a question from Olumide, who's asking what proportion of a portfolio should be used for trading FX?
Okay, again, this is, I would say, depends on someone's own return requirements, your profile, risk profile, how much of exposure you want to have in FX. I certainly think that even if you're if you are an equity bonds only investor focused mind only, and that's the whole reason why we're doing it, as I've explained in some of these things. A lot of buy and hold investors completely forget about the impact that FX is having on their returns, at least in their base currency, because they never bother about understanding their exposures to everything in their base currency or the currency in which their future expenses have to be met. So I think certainly that is very important. What is your, you have to understand what is your future expense, future liabilities, and whether your current investment portfolio is exposed to a risk where you will not be able to have a proper asset liability mismatch, so to say. So I think again, there's no definite answer to this. You need to assess your own exposures and own requirements to really understand how much of an exposure you want.
Okay, Alexandra is asking, are there technical analysis indicators that work particularly well with FX?
So I usually use the trend lines, the moving averages, the 21-day, 50-day, 100-day, 200-day moving averages. I think they give me a good sense of whether the trend in a particular pair is bullish or bearish. I think that is obviously something important to understand. And then I use the retracement levels, the Fibonacci retracement levels quite a bit to see if there are, and especially if there are, I think it's never a good idea to use one technical indicator and kind of just rely on it. I think you always have to use multiple and see specifically. I think the levels where sometimes the technical indicators kind of converge, say a moving average is converging with a retracement, Fibonacci retracement level. For that becomes a very interesting support level or a resistance level. So I would wait for those levels to be broken to take a position there. Same way, I think exponential moving average, even that is quite a good indicator of what are the levels you could get in or get out at. So for me, technical indicators have to be more than two in number to be able to make a strong case, and I only use them to understand what my entry and exit levels will be. But otherwise, my decisions are almost always governed by fundamental aspects and not so much by technical aspects.
Okay, Mahmoud is asking, how do you borrow money from a low interest rate currency in carry trades?
So effectively, I mean, it's not like you're going to a bank there and kind of borrowing that currency. When you are short a currency, it's because, so suppose my base account is in US dollars, and I'm short the Japanese yen. So someone's given me that Japanese yen for me to be able to sell that Japanese yen in the market, right? So it's all notional. It's all obviously in FX trading. A lot of it is notional. So you end up paying that interest rate, but in effect, or in fact, earning that interest rate. So if I have an investment in, say, the Australian dollar. So I've bought an asset, or I've bought the Aussie dollar itself. Again, it's not like someone's coming and giving it to me, but I am going to be earning, notionally, I'm going to be earning interest on it in my account. So, like I've shown in my costs page as well, I think it will be visible when you go. It's not visible on my demo account, so I can't particularly go in and show you here in the platform. But if you go to your live platform, you go onto the trade ticket and you click that I thing that I showed at the top, you will be able to go and understand what are your swap points, what obviously spread. I think that's obviously the most important call, but what are your swap points, which is really reflective of those differentials in the interest rates for the currency pair that you're trading. I can't hear you again, Ida.
Sorry. I think we have time for about two more questions. The first one is, what would you say that for a retail investor, FX is really just for short-term trading, except maybe for the carry trade that you talked about?
I would say that's correct. Yes, unless of course you want to put in a speculative position for a long term with with tight risk management in place. I would think that FX market is very much a trader's market, and the only reason why we do it in the long term is either for hedging. That's something I showed, right? I mean, if I am, say, involved, I'm producing products and I'm selling them in a foreign market and getting foreign currency revenues, which I need to obviously bring back to my base currency at some point of time. This is an ongoing requirement for my business. So that's also when I can trade. And this is something that usually results in a lot of futures trading, something we didn't touch upon a lot in this session today. But I think that's somewhere you use FX trading in the long term. Carry is obviously something you use FX trading for a long term, especially if you expect volatility to remain low, or if it's for diversification. Like I said, you have a portfolio which has a multi-currency exposure, and you want to just or have an offsetting FX position, so that whenever you convert back, or whenever you sell those foreign exposures and you convert back to your base currency, you don't lose money in your FX conversion as well. So I think there can be quite a few strategies for long-term trading as well.
All right, before we take the last question, I'm just going to go to our survey. I'm going to pull this up. If you could please scan the code and if you could please scan this code and just answer a few questions, it really helps us a lot improve and serve you better. So please take a few minutes just to answer those questions. And then I'm going to go to the last question, which is, Charu, is there a relationship between a country's performance and its exchange rate?
Yes, absolutely. That's a very interesting question, and that's something we are trying to understand every day. What kind of an impact the exchange rate has on interest rates have, sorry, on exchange rates. So there's certainly a strong relationship. So, in a very, very basic terms, if a country's central bank is raising interest rates, then you would expect the currency to appreciate, because higher interest rates, they usually attract foreign investment, which means there will be an increased demand for that currency. And again, yeah, conversely speaking, lower interest rates, which means that there could be some capital outflows. Investors would take money out of that country, then that can result in currency depreciation as well. So this is a key factor now, but this does not always hold true. I would say this is a theoretical way of putting it, but if I look at it from an emerging markets perspective, for example, when a central bank in an emerging market is raising interest rates, it is not necessary that investors would rush into that emerging market and put their money there, and that will lead to capital inflows and a higher or an appreciating currency for that emerging market. When they are raising rates, it could be a sign that that emerging market is potentially fighting a high inflation, which is going to be creating some economic concerns as well. And that means that the currency would potentially depreciate as well. So again, I mean, as much as interest rates are a very important factor in understanding where exchange rate goes, you again cannot look at it in isolation and say that yes, interest rates are going up, so exchange rate will go up. It's not that straightforward.
All right. Thank you so much, Sharu, for your time and expertise. Thank you, everyone, for joining us today. If you have any questions, please contact our client service department, and hope to see you soon. Thank you. Bye-bye.